Welcome to this first session on Banking Unbundled Competition in the Age of Digitization. Well-functioning retail banking markets are essential to supporting productivity, economic growth, and economic resilience. And recent work at the OECD Competition Committee has examined competition in financial markets across multiple contexts, including competition in mobile payments and balancing prudential regulation and competition considerations in retail banking. So a consistent theme has come out across this work, and that is that digitalization is reshaping the structure of retail banking markets. However, the question is whether this structural change is actually translating to durable competitive pressure. As Professor Aguillon reminded us this morning, growth is driven by creative destruction. So competition and innovation can generate competitive renewal. So to put the question for retail banking markets in another way, the question is whether innovation is truly delivering that renewal across the entire retail banking system, or whether it's merely doing so at the edges. So traditionally, we saw that retail banking markets were delivered through a single integrated relationship. That was usually a customer relied on a bank for payments, deposits, lending, and the bank controlled the entire relationship. That is changing today. Digitization has enabled new entry, including by fintech and big tech firms. Indeed, we do see some superstar firms entering these markets, and we see this most visibly in payments as well as certain data-fueled financial services such as credit provision. And this has indeed improved user experience, and it has also expanded access. However, at the same time, we continue to see highly concentrated markets across many jurisdictions, and particularly when it comes to core retail banking markets. And by that I mean deposits and lending, and particularly deposits and lending intermediation. And where these markets are concentrated across certain jurisdictions, we also observe slow and narrow pass-through of deposit and lending rates. And we observe even more that even where there are better rates out there, customers are still not switching away. So this is generally complicated by the fact that much of the new entry that we do see by these fintechs and big techs is enabled by partnerships with incumbent banks, which are the very entities they're seeking to disintermediate. This might be due to reliance on key financial infrastructures or in order to offer certain regulated services. And this can pose concerns on both a competition and prudential regulation front. From a competition perspective, blunting competition toward cooperation, and from a prudential perspective, blurring the prudential perimeter and thus complicating oversight. So meanwhile, we also see a growing role of digital ecosystems, both in the provision of these services and also in providing key inputs or essential technologies to the provision of these services. We see the emergence of new forms of money and also advances in AI, which are likely to continue to reshape competition in these markets. So against this backdrop, today's discussion will aim to assess how competition authorities, financial regulators can cooperate together in ensuring that competition delivers benefits for consumers across all retail banking services. We're going to begin by discussing very briefly the relationship between innovation, stability, and competition. Then we're going to discuss payments and then lending and deposits, which is indeed the way that we see these services being progressively unbundled And then we're going to move on and talk about the future and how continued advances in technology might reshape these markets further. And so in order to do this, we are truly honored today to count with the participation of 4 expert speakers, all of whom bring extremely strong and complementary perspectives. First, we have Benoît Cœuré, who is the president of the French Competition Authority since 2022. He was previously a member of the Executive Governing Board and Governing Council of the European Central Bank. He chaired the Bank of International Settlements, BIS, Committee on Payments and Market Infrastructures, and he also served as the head of the BIS Innovation Hub. And in 2024, Benoît was designated as chair of the OECD Competition Committee by the committee members, so he indeed has chaired many of the sessions that have inspired today's session. And I'll just note that unfortunately Benoît will have to leave us at 11:30, but we're extremely honored to count with his participation. Up next, we have Rune Garborg, who is the CEO of Vipps MobilePay, who is the leading digital wallet in the Nordics and one of the largest digital wallets in Europe. So Vipps MobilePay exhibits how mobile payments and wallets are unbundling from traditional banks into standalone wallets in cooperation with banks. The company also faces increasing competition in everyday payments from global tech platforms. Up next, we have Sheldon Mills, who is the outgoing executive director at the UK's Financial Conduct Authority, the FCA. He led its supervision, policy, and competition division. His remit focused on retail financial services, the FCA's competition objective, and he also led the flagship consumer duty reforms. And prior to that, Sheldon was a senior director at the UK's Competition and Markets Authority. And last but certainly not least, we have Dr. Nirupama Kulkarni, who is joining us virtually today. She had planned to join us here in person, but unfortunately, due to travel disruptions caused by the conflict in the Middle East, is joining us online. Dr. Nirupama Kulkarni is a professor at the Center for Advanced Financial Research and Learning, CAFRAL, that supports the Reserve Bank of India. Her academic and policy research focuses on banking, household finance, real estate, and monetary policy. So allow me to invite you to visit the OECD website to read their full biographies and learn more about their distinguished careers. Before diving in, I'd just like to flag that we're going to be using a couple polls today so as to invite you to vote and learn from your perspectives as we carry on this discussion. And we'll also open for a Q&A for both those of you here in person today and those joining us online. So with that, let's get into the substance. I'd like to start by discussing the relationship between innovation, financial stability, and competition. Benoît, could you please set the stage and tell us about the complementarities and tensions?
Oui, merci Beatriz, and first of all, let me thank the OECD for setting up this conversation, and above all, to present us with the challenge of speaking after Philippe. So we feel energized by Philippe's and vindicated by Philippe's speech, but also it's kind of a challenge to keep the audience on their toes after Philippe's performance. So we'll try to do our best, and if we fail, just following what Philippe said, if we fail, that will be part of the journey, of the innovation journey. Okay, so maybe just to set the stage, I mean, I think it's useful to say that there has always been a tension when it comes to financial services and to banking services in particular. There has always been a tension between competition and stability. So there is nothing new here, and of course we have competition authorities favoring contestability and market entry and the entry of new players, and you have prudential regulators favoring or prioritizing their stability mandate. And that's okay, because that's what we do, and that's what in our mandates. And there have been times in the past where there was no love lost between central banks and prudential regulators generally and competition authorities. I remember, for instance, and Guillaume certainly remembers, that when we had the first bail-in rules for bondholders in Europe after the financial crisis, that didn't come from financial regulators, that came from DG Comp, actually, as part of the state aid guidelines, right? And central banks were up in arms against it, saying that's so bad, you know, to bail in bondholders, that's going to create instability on bond markets. And at the end, we had it enshrined in the Bank Recovery and Resolution Directive, the BRRD, of which all financial regulators across Europe are very proud of and committed to enforce. So that's an example of convergence, in fact. It didn't start well, but it ended much better. And to be fair, there have been, in my view, two broad trends which have kind of helped align interests between and align goals between financial regulators and competition authorities. One is the crisis, the great financial crisis, and then in Europe the sovereign debt crisis, which has led to what we call too big to fail policies in financial regulation, and that has contributed a great deal to align interest, because then all of a sudden being big is bad, big is bad, both from a prudential standpoint and from a competition standpoint. And that's relatively new, in fact. So that's one evolution. And the second evolution is just digitization, which you mentioned, Beatriz, and the attempt or the temptation of big tech to venture into financial services, which creates new questions and also concerns, both from a prudential standpoint and from a competition standpoint. And that's another force for convergence between and aligning interests between competition authorities and prudential regulators. So when you think of this, of this interplay between stability and competition, what we want to achieve is to, of course, to combine both. We don't want to have to choose between stability and competition. We want to create a market structure and a regulatory environment where you can have both. And I can see three areas very shortly where tensions and complementarities between stability on the one hand and competition on the other hand can be most visible. The first is regulatory design, obviously. Regulation can either entrench incumbents or enable contestability. And I do believe we have a very good example in Europe, which is the Payment Service Directive, particularly the second one, PSD2, which has created this new status of payment service providers, which can be non-banks. So we have an example of regulation which has been pro-competitive by allowing market contestability in the payment field and spurring innovation all throughout the payment space in Europe. So that's, in my view, a successful example of pro-competitive industrial policy, if you want, in the payment field. So we haven't been able to do that very often, as Philippe said, but that's an example where regulation has been pro-competitive, and I think it can inspire us. Second area, of course, is market structure driven by digitization. So if digitization is driven by big digital firms with already a big market footprint, lots of access to data, access to clients, etc., this could lead to a world where competition is being hampered, and we've seen that, unfortunately, could lead to conduct which can be exclusionary or exploitative by these players, and we've seen that in the past. So it's not a theoretical case; it's something that we've seen. And third, when you think of the longer-term outcomes, it's not always true that it's not necessarily true that digitization will generate durable competitive pressure. If you think of a scenario, just look at what has happened in mobile payments, for instance. In many jurisdictions, mobile payments have complemented existing or traditional intermediation rather than supplemented it. It's just something that comes on top of it, but it does not really disrupt the incumbents. Innovation at the surface or at the interface, in that case, or at the front end of the market, does not necessarily disrupt incumbents. So it's not enough to speak about digitization. I mean, the way digitization will shake market structures, and whether digitization is only at the front end, at the surface, or whether it goes deep inside the infrastructures will make a big difference in terms of contestability and innovation. And I stop here.
Thank you very much for that helpful framing, Benoît. It's great to hear that we don't necessarily need to choose between stability or competition, and that indeed the two policies can be mutually reinforcing. So I'd like to turn now to payments, and particularly kick off with you, Rune, as someone who has scaled and launched a mobile payment provider. Let's start by hearing what do you think are some of the key barriers to entry and expansion that payment providers face generally?
Yeah, I would like to talk. I will, of course, like to talk about the entry points, and I think you can see that has been the NFC antenna, where you're actually paying with a phone on the terminal. The opening of that in 2024 was crucial. But before I talk about that, just look at the competition when it comes to payments. When I started working within payments, it was actually a friendly competition between banks. That was actually the competition. And we have to be honest and say the movement and the speed and the innovation wasn't at the highest level. What we're doing today is actually competing against the largest companies in the world. The best technology companies, the best brand builders in the world, the big techs and the GAFA. They are into payment, and the reason why they are into payment is, of course, because of the data. And we all know that the data, they are becoming increasingly more important. And when we're looking into the possibilities with AI and so on, of course, payment is becoming more and more important. The question is actually, where is Europe in that competition? What are we doing? Are we really heading into it to compete? Do we believe that we're going to win? And the answer is no. And what we're talking about is actually the customer interface. And when we're talking then about the opening of the NFC, that was so important, in Norway, 75% of the transaction is in-store. So obviously, when you're offering a wallet into the market and you're not present in 75% of the situation, that is a problem. That is a big problem. But that is now opened, that's fixed. Makes a huge difference when it comes to competition. And if you look at the Nordic market now, it's probably the most digitalized part of the world. We believe we're going to win. We believe that we are going to outcompete Apple in the Nordics. A lot of people are smiling when we're saying it, but that is the ambition. And if you look at what happened since we opened the NFC, we have to remember that in Norway we are approximately 5.5 million people. 5 million of them are using Vipps MobilePay. 1 million in 6 months started to use the tap-to-pay solution. And if you look at how mature this has become in the market, in Denmark, 50% are using the tap solution with the mobile phone. But what we're talking about here is not payment rails. The payment rails are important. Cost-effective payment rails, of course, they are important. What we're talking about is the customer interface. That's what's at stake. And if you lose that customer interface, it's going to be very hard to regain it. And that is what the competition is about. That is why the collaboration in Europe is more than important, and it has to happen now. Because the question I'm asking, are we creating the interoperability? Are we creating the European solution that makes us capable of competing? Okay.
Rune, just maybe to take a quick step back, and thank you very much for that. Could you tell us a little bit more about the European Commission's Apple Pay case? As I understand that you, as in Vipps MobilePay, was the first provider globally to have access to Apple's contactless technology. And again, just for background, when we discuss mobile payments, what we mean here is the tap to pay or scan to pay technology that allows you to buy a coffee or make any everyday transaction. So tell us about gaining that access to Apple's contactless technology and what that has meant for competition to have access to this wallet.
Now we have a level playing field. So now it's no excuse anymore. But without that access, it was not possible to win the wallet game. But you have to look at the digital wallet as your physical wallet. It's all your cards, it's all your accounts, it's receipts, it's ID, it's everything. But of course, you need the most common payment source and solution also as part of the wallet. So that is now in place. It's been extremely important that went through. We tried all sorts of solutions before the opening of the NFC. They were all fuck-ups. They didn't work in the marketplace. We invested a lot. We tried. But now when NFC, you can see when it's easy enough, the consumers are responding really fast. So at this stage, Apple are ahead of us when it comes to the in-store payment. Overall, we're much larger when it comes to in-store, e-com combined, and the total payment situation, sources. It's important to remember that if you hadn't been part of in-store at this time, you would eventually lost the position also in e-com and other payment situations. Because you're not going in the end to choose one wallet in that situation and another wallet in other situations. It's going to be a winner-takes-it-all game. It's not that it's going to be one player in each market, but there will be a few preferred solutions in each market, and you need to offer the whole range of products and services within that wallet.
Thank you, Rune. It sounds like some timely competition enforcement.
Yeah, we are so happy about that.
So why don't we turn to our first poll? We're going to ask each of you to use the QR code in order to vote. And the first question we're asking is, when you use mobile payments, which service do you use most often? A, Apple Pay. B, Google Pay. C, bank's payment app. D, another payment app. Or E, I don't use mobile payments. So while we give folks a minute to vote, Rune, may I ask you, would it be fair to say that you use another payment app?
I think it's fair to say that. You know, with the opening of the NFC, we can use the app everywhere in the world. So at this stage, it's available anywhere. So it's so good when you go to all over the world, actually, not have to bring your plastic card anymore. So yes, that is the answer. But I have to add as well that there are some elements in the wallet we're not offering today as air ticketing and so on. That's convenient with Apple. We'll make sure that we close that gap and increase the number of products and services in the wallet.
Excited to learn about these innovations. Why don't we see the results of the poll? Any surprises there? Well,
so please don't ask us whether there is a dominant position.
Can we use this in competition enforcement proceedings? So, Benoît, I'd like to turn to you next and ask, how should we think about the evolution of the retail banking value chain if control over customer relationships and key technologies increasingly rests with a small number of digital platforms?
Yeah, I think thinking about the consequences of digitization in terms of value creation and the location of value down the value chain. I think it's a good way also to think at the pros and cons of digitization, because on the one hand, it's very clear that digitization that is either fintech or big players coming coming to the market is something that can bring a lot of value to consumers. It can bring more products, more innovation. It can challenge incumbent, that is big commercial banks, which is good for them, I guess, and also good for consumers. And when it comes to big tech coming to this game, it can also bring it can kind of embed financial services into broader ecosystems, which as competition enforcers we can be worried about, but for consumers this can also bring new opportunities in terms of combining products and giving access to new services. So there are lots of good things coming from it, but of course it also depends on whether on how value creation will be impacted. And if the value created by these new services accrues primarily to a small number of digital players, particularly the biggest ones, which will be able to extract value up the value chain and keep it for them or for their shareholders, that's something that can, at the end, weaken competitive pressures, particularly weaken the competitive pressure on core retail banking services, even if innovation at the interface appears dynamic. You know, if the values is extracted out of the system to these big players, at the end, the competitive pressure will be lost. So we've got to be careful about that, and I think there are consequences for regulators. There are obviously consequences for antitrust regulators, and Rune mentioned the Apple Pay case, so I don't have to come back to that. That's an example of a strong antitrust intervention which has allowed to open the market and make it more competitive. There might be also consequences for prudential regulators. So of course I will let Sheldon speak to it, but I remember from my time in central banking that we had this say that, you know, the same activity and same risk should lead to the same regulation. But when you see these big players coming in, there is also a question of whether you should regulate activities or whether you should regulate entities. And it seems to me that that regulatory thinking has shifted a little bit from regulation entirely based on activities with that kind of guiding principle, same risk, same regulation, to regulation which also has to take account entities because there are such conglomerate effects and possible effects across activities, across sectors. And that's a place where competition authorities can help, actually, because we know quite a bit about conglomerate effects and tying and bundling. I mean, this is what we do. So maybe we can also help a prudential regulator think about that kind of cross-market effects of these big players coming into the market.
Thank you, Benoît. That's great food for thought and a great pitch to why more cooperation should take place between regulators and competition authorities. So I'd like to turn to Nirupama and discuss some potential policy responses. Based on your experience in India, could you tell us about the Reserve Bank of India's Unified Payment Interface, known as UPI, and how this has affected competition in payments and enabled entry or switching by consumers?
Thank you, Beatriz, and thank you to the OECD for inviting me. I'm sorry I could not make it in person due to circumstances beyond my control. Just before starting, I want to say the views are personal and not that of Captral or any other organization. So I think UPI has been a big game changer for India, and one of the defining features that makes it such a game changer is this idea of interoperability. And interoperability itself, it comes from the way the architecture of UPI, the way it has been designed. And I think to understand, how UPI works, it's easiest to make this analogy with payment rails. So think of like a customer like you and me who uses a mobile app like GPay, who then sort of wants to transfer money from payer to somebody else, a payee. And so basically I enter my details onto a mobile app. The payer PSP then communicates with UPI on which is basically the infrastructure, the digital public infrastructure. And from there is this communication with the bank of the payer, and then the money is debited, credited to the payee, and then that information is communicated to the payee through another app. And so essentially, if you think about this in the context of a payment rail, this would mean that you and I are the passengers. The train is basically the things like Google Pay, and the payment rail itself is basically UPI. And so essentially what this whole structure has done is that it's basically unbundled deposits, payments, as well as this third-party app. And so this has been a big game changer, because from the customer side, it means that it's very seamless. I can be on any app, and I can belong to, say, a bank like SBI, which is the largest bank, and the payee can be on another app like ICICI, which is a private sector bank. And this is very unlike what you see in the US, say in Zelle or Venmo, where again the payer and payee have to be on the same app. And in a sense, this idea of interoperability, this idea of like how should competition be, how should new entrants be able to enter, what is the customer experience? This is all baked in at the time that the UPI infrastructure was envisioned. And so that has essentially meant that both scaling as well as this how easily new entrants are able to come in and how easily customers are able to use different kinds of apps has been sort of predetermined. And this is especially stands in sharp contrast to our experience with other kinds of digital public infrastructure, DPI, like account aggregators, where this idea of interoperability was not baked in the beginning. And again, as the market evolves, of course, there is a tendency for these anti-competitive effects. But the regulator, I think, this idea of it being a level playing field has, again, it's been on the regulator's mind. So you also see this in the way like something like the Competition Commission of CCI stepped in recently when they felt that GPay was acting in a very anti-competitive way. And in fact, this was in regard to the Play Store app, wherein it was much more difficult to use any other app besides GPay. And they came down, they imposed heavy penalties to make sure this doesn't happen. So again, this is all, for India, it seems that the way the UPI was designed itself meant that we are doing well on all these three fronts.
Thank you very much for sharing that, Nirupama. It's really important and interesting to hear that the CEI, the Competition Authority in India, is also really quite active and ensuring that UPI remains open. And it's really interesting to hear how the design was meant to be interoperable and open, and how that might compare to incumbent-controlled payment rails in other jurisdictions. So I'd like to stick with you, Nirupama, and hear a little bit more, zooming out of payments and moving on to retail banking more broadly. Could you tell us about the competitive landscape in India in deposits and lending?
Sure, thanks, Beatriz. So this is a very close to my heart. I do a lot of academic work, and this is something that I've been looking at over the past few years. And so to think about this, I think it's useful to think about how deposits and lending was before UPI. So in India, deposit rates especially have been highly regulated, which means that even the deregulation of deposit rates for term deposits started in 90s, but for savings deposits they were deregulated very recently in 2011. And so what happens when the deposit rates are regulated? Deposit rates are low, which means banks are able to raise funding cheaply. But it also means that savers are less likely to save in the form of deposits. And so that means that there's less penetration, at least in the deposit market. On the bank balance sheet, because funding is cheap, banks can get away by just investing in government securities. And so that means that there is less left to lend to maybe firms and households. And so both on the asset side as well as on the liability side, there is sort of less financial intermediation. Even in one of our papers, our Capral working paper, we found that even after the 2011 deregulation, there was not actually much of an impact. It did not seem like deposit rates increased and this financial intermediation improved. And so, another way that we can achieve this kind of low deposit rates is if market power of banks have all the market power. And the Indian banking system has always been a very concentrated banking system. And we have only about 50 scheduled commercial banks. And so now, cut to now, we now have that UPI has come in, and UPI has sort of it's made especially on the liability side, the digitalization has made this financialization of savings. So what has happened is that savers now can easily basically compare the deposit rates to say, what they would get when they invest in a mutual fund, or if they participate in stock market. And because of digitalization, there is this easy shift of deposits away from banks to these alternate investments. And as a result, the banks themselves have had to raise their deposit rates. And sort of a similar channel also affects the asset side of banks. So on the asset side, because there's much more retail market participation, it means that the corporates themselves are turning to the stock markets, to capital markets for funds, as opposed to borrowing from banks. And, again, separately, it seems that the UPI has also had an effect in the way banks lend. So, because there can be cash flow based lending, because, lenders can now use alternate information to lend. There has been a revolution on the asset side also. So while fintechs have used UPI for cash flow based lending, the banks, for them, UPI has been a game changer because of ease and speed. So basically on my app, I will see loans sort of advertised to me. And because these banks are able to tap into different market segments, though of course, still the prime borrower, they have increased the retail lending. So there are all these different opposing forces that are acting on the bank in the banking sector. And, on one hand, because of what we are seeing on the deposit side, we especially, in the context of what I described earlier, that is, when rates raise, it might actually force the banks to become much more efficient. They might have to find out new ways to lend, new markets to lend, as opposed to just investing in the sovereign in treasuries. And you're already seeing that. So, for example, the CEO of the largest bank is now focusing on basically how to churn assets better on the asset side through securitization. And so, overall, there might be this short-term pain, but in the long term, UPI does seem to have, at least pushed banks into becoming more efficient as opposed to what it was in the past.
Thank you, Nirupama. That's incredible to hear about the benefits of UPI, including on pass-through deposit rates. I'd like to now turn to you, Sheldon. First, let me ask you, have you ever heard the adage that a consumer is most likely to divorce than to switch bank accounts?
Yes. Yes.
So, with that backdrop in mind, let me ask you, could you tell us a little bit about your experience in the UK assessing concerns related to deposit and lending markets, including related to limited switching?
Sure. I always feel bad speaking about this because I have been with the same bank in the UK since I was 7 years old, and I've never switched, and I've never opened another current account. But with that disclaimer, this is what I'm going to say about competition in UK banking. So consumer inertia has been a problem in retail banking. I think that is reflected across most of Europe as well, not just in the UK. As people may know, the Competition Markets Authority that I used to work for did a market study into retail banking in 2016 and found significant dominance of 4 players in personal current accounts, deposits, SME lending, business current accounts across the piece. I went to look back at some of the shares, and I mean, there hasn't been a huge amount of change in personal current accounts deposits. I mean, there has been some movement downwards, but they still hold around 70, 75%, and they were sort of in the they were in the early 80s 10 years ago or so. But what you have seen, and I think it's reflected across this really interesting conversation, is the emergence of lots of different types of activity, which I think takes away some of their profitability in certain areas. I think I put it like that. And some of that does relate to customers voting with their feet to stay on the demand side. To give examples of that, we have the number of current accounts in the UK is above 100 million. The number of people in the UK is not above 100 million at the last count. So people do multi-bank. Where the main banks really hold their power is if you ask them how many of their customers put their main salary each month in their bank account, they still have quite a high percentage. So you can imagine the amount of cross-selling they can do through that sort of activity, including people who run their business through their current account, although we've tried to put a stop to that. But what we have seen is a huge emergence of what we call neobanks or digital banks. And it comes on to something that Benoît was talking about and also that Rune was talking about. Some of them have come through payment systems regulations, firms like Revolut. Others, the prudential regulator has put in place a different standard for smaller banks to enter banking, and we at the FCA have also participated in that. So I wouldn't say it's easy to become a bank in the UK. It's not, but it was a little bit easier at a point. So we saw firms like Monzo and Starling come through. And what you've seen, Monzo, Starling and others, neobanks, now have around a 10% share of the current account market from 1%, sort of, let's say 2018. That's quite a big jump. And I think there's a few things which relate to the discussion here. Some of it is how we shifted regulation. Some of it is technology. Those entrants could become digital only banks. Most of them have no physical presence. Just for those who know the UK, we did have a telephone bank called First Direct, which, because people say, oh, there's never been a bank with no physical presence. First Direct was around for a very long time. It was a telephone bank. So we have had that before, although it was part of NatWest. And so those neobanks have come through. And then we've seen the emergence of what I call, well, let's call them payments firms. But some of them operate in a way that is close to having an account for a bank. So you can put money in there and you can make payments from those accounts. Revolut is one of those. They started really coming through on the Forex market and taking some of the money out of the main banks on Forexes and really bringing down fees on Forex. Quite amazing business model. So we're seeing a much, to take the title of your session, we are seeing in the UK banking becoming unbundled. One final point is, I can't remember who, sorry, I came from Japan this morning, so my notes aren't very good. They're not in Japanese, but they're not great. But I was looking, and there was some research done recently. I'll have to find it. If people are interested, email me, and I can send you exactly what it is. But it said something around about 30% of people would happily switch their current account to one of the GAFAs if they entered banking. And that goes to your point around customer interface. I think what technology has driven, what the market for attention on the supply side, the need to get more data as now the old oil, not the new oil, means in effect that the thing which protects some of these traditional banks is actually in part regulation. Because to come into banking and take deposits and formally lend, you have to go through a very significant process with prudential and conduct regulators. And I think that is not something that some of those firms are willing to do. But apart from that, there are a lot of the possibility that one could enter. And I do agree with you, Benoît, that there is an interesting debate to be had around entity-based regulation. Certainly, we've started that a little bit in the UK. I know Europe has as well, with the critical third parties regime, which looks, at the time it was created, it was about cloud infrastructure. Now, who knows? It might be more about AI and generative models, etc. But I think those types of regimes are regulators and policymakers trying to understand how do we not dampen innovation, but still have some oversight of what are important actors in regulated systems.
Thank you very much for that, Sheldon. We're so grateful that you made that flight and got in this morning. So we're going to turn to look to the future shortly, but first, why don't we test that adage? Let's pull up the second poll. And the second poll does not ask if you've ever gotten divorced. However, it does ask, have you ever switched banks? And the options are A, yes, multiple times. B, yes, one time. C, yes, one time, but I continue to rely on my primary bank, which is what Sheldon was referring to. Or D, no. So we know that Sheldon has not switched banks. Rune, may I put you on the hot seat again and ask you?
Yes. No, I've been working in a bank for a lot of years, so I have to say that I've never switched. The latest 30 years. But before that, I had another bank, yes. But my children, they don't care about banking at all, so they just want that solution on the mobile payment, and preferably it's the Vipps MobilePay solutions or it's the Apple solution, so they're not engaged in banking at all. They don't care.
So let's pull up those poll results, and maybe the question we should be asking, and I think you have told me this before, is will 10-year-olds today open a bank account in the future? Let's see the poll results. Okay, while we wait for those poll results, why don't we actually turn to the future? Sheldon, I'd like to hear from you, looking ahead, whether you see AI-driven tools having the potential to overcome that long-standing customer inertia in retail banking and materially increasing switching. Particularly, I'm curious to hear whether you think aggregating information or prompting decisions or even executing decisions for a user might be what the future will bring.
Yeah, absolutely. And I'll be quick because I'm quite interested to hear what Rune and other panelists have to say about this question as well. It's timely for me. I'm doing a review for the FCA board on the long-term impact of advanced AI on retail financial regulation. I couldn't think of a shorter title. I think, and we're looking to 2030 actually, so I'll just test my premise with you. So how we see in our sort of premise, our future-looking premise of how retail financial services will develop is that your children, and possibly us, will have an agent. That agent might be provided by your bank, your traditional bank. They're all seeking to develop these in the UK. I'm sure they are thinking about that in Europe as well. Or it might be provided by one of the major firms that we've been talking about, or it might be provided by one of the model providers, or someone else. And that agent may well deal with you just in relation to your banking, or it could deal with you in relation to all of your financial health, or it could deal with you in relation to all of the major things that you do in your life. It will be able to contextualize your information and your data, and given all of the movement that we see in payments, where it is already possible for an agent to execute on your behalf, most of the protocols are in place. They just might not be live yet. It will be able to, depending on consent mechanisms and a whole host of law that needs to be developed, be able to execute on your behalf. And I think the reason why I put that sort of 5-year vision, although some people I speak to say it could happen in 24 months, is because when we discuss banking or any form of regulated service, we still discuss it in analog terms of going into a branch and doing things. Even payments, we discuss of a transaction. Actually delegating agency to AI to think on your behalf, to develop plans for you, financial plans for you on your behalf, and execute on them in some sort of automaticity will raise lots of different types of issues. And from a competition perspective, it could entrench even further some of the firms that we have been talking about, depending on how that is deployed. You asked a few questions. I mean, there are lots of issues which flow from that, some of which are financial conduct type issues, but obviously consent, security, permissions, those sort of issues are important. Issues around advertising and conflicts of interest as they run through those things, reliability and control. And then to come back to competition and to go to Benoît's points around prudential, if you came to a world in which deposits moved very quickly because your AI is just looking for the best rate for you, then there do come through certain prudential considerations, which in competition economics we'll think about systemic herding and those sort of issues. But there's a range of issues that you can debate in relation to it. My only point, I think, is that I do think that that future is nearer than we think.
Thank you very much, Sheldon, and we'll come back to ask you about the Mills review a little bit more, but before we do so, we'd like to hear from Benoît before he has to leave. Any reactions?
Yeah, so when it comes, I mean, there will be another session on AI later today, so maybe we should keep, some meat for that discussion. But from a competition standpoint, what I would first like to say is that AI is a general purpose technology, so what we want to see is AI boosting productivity and benefiting consumers and citizens all across the economy. We want to make sure, just coming back to what Philippe Aguillon said earlier, we want to be sure that the impact of AI on total factor productivity will be 0.7 instead of being 0.07. And that's where competition will help or can help. And without competition enforcement, we're pretty sure that it's going to be 0.07, not 0.7. So that's how high the stake is, right? Then when it comes to financial services, more specifically, there are lots of good things that AI can bring in terms of lower costs, in terms of improved customer experience, in terms of new services. But in financial services, just like in any other industry, it can also concentrate advantages to firms with privileged access to data, privileged access to infrastructures, particularly computing power and energy, and privileged access to talent. So that can actually raise barriers to entry in financial services, just as in any industry in the economy. And that's what we should be looking into. And maybe something more here, and that relates to what Sheldon said earlier on critical services providers. AI also can transform banks' internal operations and shift the boundary between what's happening inside of banks and what is being outsourced. If you think of cloud services, obviously cybersecurity, advanced analytics, advanced data analytics, and so on, this can shift part of the value added of the activities and possibly value added outside of the perimeter of the company. And these infrastructures themselves, these layers themselves, they are highly concentrated. So that creates new risks, both in terms of competition and in terms of prudential risks, in terms of having to rely on a limited number of providers. So concentration risk, which matters both for competition authorities and for prudential regulators, and that's what we will have to look into in the future. And maybe one last word here is that it's not only about prudential authorities and competition authorities talking together. It's not only about the interplay between competition and financial regulation, it's also about regulation in the broader sense. And so if you take the European regulatory landscape, for instance, pieces of regulation, such as the Data Act, such as such as DORA, you know, the resilience regulation, they will have also a big impact. So it's a triangle actually. You have prudential regulation, you have competition, and you have industrial regulation in a broader sense, and all that pieces have to fit together.
Thank you very much for that, Benoît. And thank you again for joining us today, of course. It's great to hear how all of these pieces of regulation can be complementary. And we're going to open to Q&A very soon. I just want to check, Rune, do you have any reactions, or Nirupama? Oh, I see that we also have our poll results. And are you surprised? Did you expect this? Yes. Okay.
Yes. Yeah, I think so. And if you add age, that would be interesting as well, because if you look at the loyalty among people my age is really high, but it's a lot of young people here as well. They are not loyal at all. And if you look at Revolut, you mentioned Revolut and what they are doing, it's rather impressive. More than 30% of the opening of accounts in France last year was with Revolut. And I can say when you look at all their marketing in the airports and everywhere, they are not talking to me. They're just talking to young people. They know that the loyalty is much lower. They have fantastic marketing, they have innovative products, and they are gaining a lot of traction. So I will say when you, Sheldon, talk about the neobanks, I really find that interesting, because you're not necessarily changing your primarily bank, but you're certainly adding one or two more. And when we look at Revolut, they will soon offer mortgages all over Europe. So it's just the starting point, and the competition we're seeing now is raising to a new level. So I think if we go back to this in 3-4 years, it's going to be a much more rapid change than we've seen the last 10 years. So we'll wait and see.
We'll certainly wait and see. So with that, why don't we open for some questions from the audience? If you're here, please tell us your name and let us know if you're addressing the question to someone in particular. And we'll also be taking online questions, so please do feel free to add your questions to the chat.
Good morning, Maria Uli. A question addressed to everybody on the panel, and it's triggered by the points you made earlier about ownership of the interface, the customer interface, and the point about controlling that. And I wanted your perspectives with regards to ownership of data. Financial data, but also personal data, and how access to this data may help unbundling the value chain and promoting innovation. And I'm interested in the perspective of the regulator, but also from the business side.
Well, I mean, it's as Benoît says, there are a lot of regulations around control, ownership and use of data. In the UK, one of the remedies coming out of the CMA's retail banking study was that the nine major retail banks needed to set up a common standard so they'd have APIs so that if customers give consent, then their data could be shared between those banking institutions, so that those banking institutions could provide different types of products and services to them, in that way seeking to open up competition. I think at the last count, there's around 11 million active users of open banking. It has removed lots of friction around both account opening and sharing of data in relation to that, but also in relation to payments. My own, and we're continuing with that at the FCA, so we continue to build on, the UK has a policy, the Data and Access Use Act, which was just passed last year, which tries to bring a sort of smart data economy into the UK, where you apply these sort of open data standards across different aspects of the economy. I still think it will be important and remains important for individuals to understand how their data is being used. But I think it will also be important to work through what types of consent mechanisms can reduce friction to the least possible amount to allow for the efficiency that you want in relation to AI-enabled payments, transactions and contracts, whilst protecting whatever society or regulators feel is necessary in relation to data. I think that is going to be a challenge. When I speak to the Information Commissioner's Office about that, I think it's quite clear that data protection regulators around the world are trying to think through some of that. From a payments firm perspective, it is also a challenge, and I'll pass to Rune as he's been thinking about that.
I think this is becoming more and more important to be the preferred player in the market. We're talking about control of data. Soon, I hope you'll find a panel in our mobile payment solution where you decide what kind of data I will be willing to share. And it's going to be specific. So making sure that the user is in control of their own data is going to become a clear competitive edge. And I think you'll see much more of those solutions, because when you're in doubt of wanting something or sharing something, you can just shut it off. And I know that sounds a little bit simple, but that is simple with the digitalized solutions. So we're testing it right now, creating a personal panel for the user to say exactly where they would like to share data to enrich also the customer experience, and where they're not willing to do it. So we're tailor-making this for each and every customer, and we hope that is going to give a higher degree of trust among users. But I think this issue is becoming more and more important, especially with AI and so on. So if you're not clearly stating that you are in control, it's going to create a lot of skepticism.
Thank you for that great question. I believe we should have time for at least... Oh, Nirupama, please go ahead. You are muted.
And so the basic principle is that the data belongs to the consumer, which means that all of the UPI data, I have to give consent if it has to be shared across entities. And we also have in place something called an account aggregator, which is basically a consent manager, which basically, it means that I can consent to data being shared by my bank to, maybe a fintech entity, say if I want to get a loan. And of course, although the data is with me, it belongs to me, it could be that, maybe if, like the bank can introduce like a glitchy system, which makes it more difficult to share data across these consent managers. But in a sense, I think the guiding principle has always been that the data resides with the consumer. And this is in contrast to, say, PIX, where the data is with the, the central bank.
Thank you very much, Nirupama. And I believe we should have time for one more question and very limited responses of 1 minute maximum.
Oh, I'm sorry. Then, fine. I'm K.K. Sharma, former Director General Competition Commission of India. And after 2012, I'm practicing, so I'm seeing things from both sides. To me, Nirupama spoke about the new interface, UPI, and the other Google and all. Mills spoke about the consumer inertia. I do agree, but to a limited extent. Why? I personally feel, as on today, deep pockets make a huge difference irrespective of what is being done. UPI, let's not forget, is not a private innovator. It's a company established by the Government of India, having deep pockets again. It is much better. Google Pay, when it came in 11-12, 3-4 entrenched players were there. They were the leading ones. I thought perhaps it will not succeed, but it succeeded. And even now, because of bundling and so many things, the penalty which has been imposed on Google Pay, they registered a lot, had all top layered lawyers. So I have got a feeling, come what may, unless the competition agencies wake up, do something drastic, including financial market authorities, the deep pockets and the market enchantment is leading to their continuing dominance. And if a new dominant player joins, as it happened in Google, in no time they will overtake the market. So if there are some solutions from any one of you, most welcome.
Just briefly on that. I mean, I think it goes back to a theme which came through with the speech, which was around middle-income countries, and maybe I shouldn't call the UK a middle-income country, as I'm still a regulator. But anyway, I just did it. We're not. But I think what happens, and it's a question for us as competition experts, and it goes to that point around merging competition and industrial strategy. When you want to create something which has massive network effects and has huge public benefit across society, as UPI has done in India and in Brazil, the PIX has done, both of those examples have had huge government backing in different ways. And then they've opened up opportunities for private commerce to come in and provide different services around it, but they've created the rails. We're trying to do something like that through open banking in the UK. And I'm allowed to say now that actually these activities have been much more successful in India and Brazil. I think that is the case. So I do think there is a reasonable debate around whether or not government or some sort of government type scheme or regulation can empower. But we've heard today PSD2 and PSD3 has unlocked a whole host of innovation in payments and has done something not dissimilar to UPX. So it kind of depends on where I think society wants to take those benefits and how they do. If you are correct and large players do take ownership and have those network effects, then of course it's really important for competition authorities to have appropriate powers and to be able to enforce after the event or in advance of the event, depending on how the agency works. And I think in a sense we do have a system which both allows for that level of innovation but also comes around. My only worry is that when I look at Brazil and India, the benefits economically for growth, for financial inclusion are huge. So when we talk about Europe, and I'm including the UK and Europe in this statement, you can kick me out again if you like, but we kicked ourselves out. But if we think about our growth challenges on this continent, the way in which we transact is a really important part of that. And the way in which we lend and the way in which we deposit is super important. So removing friction in relation to that and ensuring that that's done economically in an efficient way might well be a priority for us.
Let's go to Rune and then Nirupama, but as we're getting very close to time, I'll ask you to keep it very short.
Yeah, but very short. I think from the outside, I don't know this very thoroughly, but I'm really impressed to see the growth. It looks like it's really customer-centric, and it looks like it's increasing the competition. But there are always pitfalls. I have to say that I'm using this as an inspiration when we're talking about Europa, how we are creating interoperability in the European market, and to make sure that we force simplicity, that we urge to create the most simple solutions, and making sure that the competition is at the highest level. So that's my impression from the outside, but I hear the skepticism as well.
Nirupama?
Yeah, I think much has been said already, so I don't have much to add. I think the regulator does keep a check on it. The way UPI has taken off, and also not just the direct effect, but also the indirect effect of UPI. I think that's something that's important. And so if the regulator does come in and sort of stall growth, I don't know if at this point that's necessary. But the points have been made. Thank you.
Thank you all. Well, I see that there was more questions around the room, so I invite you to ask them over coffee when we follow. And I'll note that we generally discuss retail banking and how this is unbundling, and generally how we hear financial regulators, competition authorities are working hard to reduce barriers and stop that consumer inertia. So it feels like the policy challenge ahead will really be to ensure that innovation translates into durable competitive pressure throughout the future for those 10-year-olds and for us. So join me in thanking our wonderful panelists. Thank you.
Thank you very much, Beatriz, and to the panelists. You